Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be studying the ultimate oscillator. I'm going to show you how to use this, and I'm going to compare it against the slow stotch. You'll understand why in a moment. The ultimate oscillator was developed by Larry Williams in 1976. It's a momentum oscillator designed to capture momentums across 3 different time frames. This is not something that is done with other oscillators. The other oscillators will use a single time frame, and the ultimate oscillator strives to average out to get a clearer picture. Anybody who's ever done any trading with divergences know that divergences are great trading opportunities, are great signals. However, they can give you you can get false divergences that actually never materialize, and you are trading in the wrong direction when you see those situations. So to avoid those is paramount, right? Well, the ultimate oscillator is designed to avoid those, and I'm going to show you here how well it does that. And in fact, it'll even pick up some divergences that other oscillators miss, which is quite effective and very powerful tool. I'm going to start off with a quick breakdown of how it's laid out. It's a bound oscillator, so it runs from 0 down here to 100 up here. Whenever the particular plot point runs across the 70 line, like it did here, it's considered an overbought signal, or it can be an overbought signal. It doesn't always, but it can be. Whenever you're trading sideways, it's a great oscillating tool for finding overbought and oversold conditions. Oversold would be below the 30 line, like we have here. Okay, so it works a lot like your RSI or your slow stotch. The slow stotch has got an overbought reading at the 80 line above that, and oversold below the 20 line, right? So this is all, we're using the same concepts here, just a different method of applying the data. This one's using 3 different plots that are averaged, and this one, of course, is not. It's using 1. As with most of your momentum oscillators, every one that I use, you'll notice that there's the 50 line or the center line in the particular oscillator. And oftentimes when you're in a strong bull situation, you're going to stay above that 50 line or bounce, find support at the 50 line. Or when you're in a strong bearish situation, you'll find resistance at that 50 line and you'll stay below it. So typically whenever you're above the 50 line, it's considered bullish. When you're below it, it's considered bearish. Buying pressure and its relationship to the true range forms the base for the ultimate oscillator. Williams believes that the best way to measure buying pressure is simply subtracting the close from the low or the prior close, whichever of the two is the lowest. This will reflect the true magnitude of advance and hence buying pressure. The ultimate oscillator rises when buying pressure is strong and falls when buying pressure is weak. Okay, so now we all kind of get an idea of what it's doing and how to read it. Now let's actually figure out the buy and sell signals. Larry Williams would look at the ultimate oscillator and find bullish or bearish divergences. If you found a bullish divergence, it was a buy signal. If you found a bearish divergence, it was a sell signal. So let's look at the first one. A bearish divergence forms when price activity makes a high point, pulls back, makes a secondary high point that is higher than the first, showing an uptrend. However, your indicator will not reflect that. In this case here, you have the ultimate oscillator showing a high point here, a lower high here. It's trending down, telling you momentum is weaker than price is reflecting here. And this is a sell signal by Larry's definition of using the ultimate oscillator. And however, if we look at the slow stotch here, you can see that they actually miss it. Here you have slightly higher points here, so it's actually missed by the slow stotch in that particular case. Here we have a situation where price has made a high point, advances to the high, pulls back, advances to another high. Note the high point here, trending higher. Note the slow stotch shows here and here, trending down. Right? Corresponding, the ultimate oscillator shows here and here, telling you there is no bearish divergence, while again the slow stotch sees a divergence. That would get you into trouble if they're wrong, which apparently they are wrong a lot more often than I would have expected. Going back and looking at different charts, I find them miss several opportunities that the ultimate oscillator does not miss, and call several false signals that the ultimate oscillator does not fall for. So that is an excellent benefit there. Let's have a look at a positive divergence. Here you're going to have a low point on your indicator, a lower low, okay, showing downtrend there. Corresponding here, also caught by the slow stotch, and the corresponding low points here and here are showing an uptrend. This calls for a bounce to the upside, which you got here. In this particular case, the slow stotch nailed the same call that the ultimate oscillator had nailed. Okay, here we have a high point. We've advanced to this point, pull back, advance again, pull back. Alright, showing a downtrend here, and the ultimate oscillator's corresponding highs here, here, here. We're trending up while price could not maintain that level, and this is a sell signal. However, you will notice that, again, the slow stotch missed this particular negative divergence. For a buy signal, Mr. Williams would look at the bullish divergence. We have a situation where we have a low point and a higher low on your indicator, the ultimate oscillator. In this particular case, the slow stotch also caught it, so I'm not showing the slow stotch. I'm just going to show you what this looks like. And you've got a low point here and corresponding with price, and a lower low here. This just shows that price is overshooting to the downside while momentum to the upside is increasing. Therefore, this overshoot to the downside is not going to be sustainable. The way to get into that would simply draw yourself a trend line, and when you see the breakout, you see close above the trend line, and you can take your entry opportunity. In some cases, you'll have a breakout, and then she'll pull back down to this previous resistance trend line and see if it's acting as support. In this case, you can see that it was or is, and so it's a good buy signal according to the ultimate oscillator. The last item we'll look at here, like I've already said, the ultimate oscillator can do whatever the other oscillators can do, including the RSI and its failure swing method. So when you're looking for a failure swing, in this case we're looking at a positive one, you will fall below the 30 line. Note the 30 line's over here. Okay, you'll fall below that. You'll advance back above it, staying under the 50 line, pull back down to the 30 line and be unable to cross back below it, and then advance higher. When you break out above this high right here, this 50 line high, that would be the confirmation of a failure swing. Actually, it pays no attention to price in this situation. Whenever you see these, in this particular case, it wouldn't have worked out that well. You may make a little bit, but it's not very effective in that particular chart. However, this is a tool you can use when you're analyzing the markets or individual assets as you may be looking at. The ultimate oscillator works much more effectively at catching failure swings than the slow stotch will, which, by the way, the slow stotch missed this particular opportunity. For those of you who may be new to this, that was also a situation where you had a bullish divergence. If you thought you saw that here, trending up like this, while the corresponding low points here and here were trending down, if you thought you saw a bullish divergence, you were right, you do. But in this particular case, drawing your trend line there, draw your trend line out there, and you just had like you had to buy at the close of this day to play this game and to make any money here because of the major gap that you had following day. So in that particular case, it wouldn't have been of great value to you, but it still does call them, and that's important to note. Now you know. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.